The stakes for Tesla have never been higher as the company confronts a critical juncture in its global expansion strategy. The repercussions of China's retaliatory tariffs extend far beyond Tesla's operations within the country, symbolizing the broader economic conflict between the U.S. and China that is reshaping industries worldwide. Once regarded as the undisputed leader of the electric vehicle EV revolution, Tesla now finds itself in a battle for survival. Its future in the world's largest car market is suddenly uncertain, with its ability to adapt to a rapidly evolving geopolitical landscape and shifting market dynamics becoming crucial for its long-term viability. One of the most immediate consequences of the tariffs is the increased cost of Tesla's vehicles. High-end models like the Model S and Model X, often seen as premium purchases, may become less attractive to consumers, particularly in price-sensitive markets like China. The added expenses could drive potential buyers toward more affordable alternatives from domestic manufacturers, such as BYD, NIO, and XPeng, which are not burdened by these tariffs and can offer competitive pricing. This shift could lead to a rapid decline in Tesla's market share as Chinese consumers increasingly opt for locally produced EVs, which are also supported by government subsidies. Tesla's global brand reputation, built on its cutting-edge technology and premium status, is also under threat. In recent years, Tesla has enjoyed a strong following in China, where its vehicles were seen as symbols of innovation and status. However, rising nationalist sentiments may lead some consumers to view Tesla's offerings as overpriced foreign imports, particularly if tariffs push prices beyond reach. This change in perception could benefit local manufacturers, whose vehicles are increasingly matching or surpassing Tesla in terms of technology, range, and performance. The allure of owning a Tesla, once tied to high-tech sophistication and eco-consciousness, may diminish as Chinese consumers gravitate toward more affordable, patriotic, and domestically aligned alternatives. As tensions escalate, Tesla faces a difficult dilemma. The company could absorb the additional costs imposed by tariffs, but this would further strain its profitability, which is already under pressure from rising raw material costs and slowing demand in other regions. Alternatively, raising prices to offset the tariffs risks alienating its core customer base, who may be unwilling to pay higher prices when cheaper domestic options are available. Both choices carry significant risks, and Tesla's management will need to make tough decisions in the coming months to navigate this volatile environment. Simultaneously, Tesla must address the broader impacts on its global supply chain. The company's reliance on Chinese manufacturing, particularly its Shanghai Gigafactory, has been crucial in meeting global EV demand. However, the tariffs highlight the fragility of the current supply chain, especially amid rising trade tensions. Critical materials for EV production, such as lithium, cobalt, and nickel, are often sourced from China or its allies. If Beijing imposes further restrictions or raises export tariffs on these components, the entire EV industry could face significant supply shortages, driving up costs for automakers worldwide. This would make it even harder for Tesla to remain competitive, as it would struggle to maintain production volumes without passing on additional costs to consumers. Looking ahead, the uncertainty surrounding these tariffs could disrupt Tesla's long-term expansion plans in China. The company has made substantial investments in the country, viewing it as a key market for future growth. The Shanghai factory, for instance, has been central to Tesla's production strategy, enabling local manufacturing and avoiding high import tariffs. However, if trade tensions continue to rise, future investments in China may become less appealing. Tesla could consider redirecting its investments to regions with more favorable trade relations, such as India or Southeast Asia. But this would require significant financial resources and time to establish new supply chains and production facilities. Moreover, relocating operations could disrupt Tesla's existing relationships with suppliers and customers in China, where it has built a strong brand presence over the years. The global automotive industry is closely monitoring this situation, as the outcome of the U.S. China trade dispute could set a significant precedent for other manufacturers. Companies like Ford and General Motors are also navigating these challenges, and the decisions made by Tesla could influence broader industry strategies in an increasingly uncertain geopolitical and economic landscape. Volkswagen, along with other major automotive companies, has heavily invested in China, but they may encounter significant challenges as trade barriers continue to rise. As the situation develops, it is evident that global automotive giants will need to reassess their strategies for operating in China and other markets where trade relations are increasingly uncertain. Many companies might start diversifying their supply chains to reduce their reliance on China, shifting focus to other emerging markets where production costs are lower and trade dynamics are more stable. The ongoing trade war is also reshaping the global perception of electric vehicles, EVs. With Tesla facing higher tariffs in China, domestic EV manufacturers are seizing the opportunity to strengthen their position as leaders in the sector. These Chinese companies benefit not only from lower production costs, but also from strong government support, which is heavily invested in advancing the EV industry. Over time, this could result in Chinese EV firms, once considered secondary players, surpassing Tesla in both market share and technological innovation. If Tesla fails to maintain its presence in China, it risks being overtaken by these domestic competitors, particularly in a market that was once its strongest. Tesla's future in China and its global dominance will largely depend on how well it navigates this increasingly volatile and competitive landscape. Elon Musk's leadership will be put to the test as he faces this geopolitical crisis. While Musk has a reputation for making bold decisions and adapting swiftly, the current situation demands more than quick thinking. It requires strategic foresight and the ability to balance competing interests. Tesla's survival in China may depend on its capacity to diversify its supply chains, renegotiate trade agreements, or even relocate parts of its manufacturing operations. In the coming months, the EV industry will closely monitor how Tesla addresses these challenges. Whether Tesla emerges stronger or is forced to retreat from one of its most critical markets will have profound implications not only for the company, but also for the future of the global electric vehicle revolution. For Tesla, the challenge is not just maintaining its competitive edge in China, but thriving in a rapidly evolving global market shaped by geopolitical forces beyond its control. The outcome of this trade dispute could significantly influence Tesla's future trajectory and its role in the global EV race. Once a symbol of rapid growth, Tesla now faces tough questions about its reliance on the Chinese market. If sales in China decline sharply due to rising tariffs, Tesla stock could experience significant downward pressure. The company has already seen stock price volatility driven by concerns over slowing demand, highlighting the precarious nature of its position in this shifting landscape.